Hello, everyone. Good afternoon. Just as a quick reminder, we have our final chapter before the first exam this week. So next Monday, we'll have our exam review and we'll have our exam on Wednesday. Now everybody's looking forward to that. And so just wanted to remind you that the materials for the first exam are available on Brightspace, the study guide and the practice exam. So please make sure you take a look at those. As always, I will not cover every single thing detail on the study guide. So if you have questions about something that you want particular clarification on, come to class ready to ask questions. We will go through the study guide in high level detail. We'll go through the exam for practice exam in scrutinous detail. Is that a word, scrutinous? If it isn't, it should be. All right. Yeah, so please make sure you're prepared for that. I encourage you to work on that over the weekend, be prepared to come into class. I think I've said this in AIS, so as a reminder, please make sure you complete the practice exam before you come to class. It really defeats the purpose of not having done that if you come in. But the practice exam key will be available online at the start of class next Monday. Today, we are covering, so just for context, I personally believe Chapter 5 to be the most important chapter in the entire course. And I personally believe today's lecture to be the most important of the two Chapter 5 lectures. So I believe today to be the most important lecture. There is a lot of content we're going to go through today, and I don't expect you to master it today. I expect you to have semi-mastery of it by the time we hit exams. But the good news is we've got 2 whole lectures about this, one of which is going to involve a discussion that everybody's been assigned to a specific topic for Wednesday. So you might want to take a look at the Wednesday discussion. If you come into Wednesday and say, I forgot to look at the discussion, Dr. Barnes, you will get a frowny face. All right. And so that's a frowny face from me, and maybe one written on a piece of paper somewhere. I don't know. But please be ready to come in. We'll talk about how you should approach that topic, how you should approach the questions today. That being said, there's a lot to cover. There's just no way around it. This is the starting point for basically all the things that we're going to be doing for moving from the course. Okay, this is going to be how we approach testing, how we approach document gathering, document retention, things along those lines. It's not going to seem like a lot of information, but it's a lot to absorb. And probably the more important thing is that memorization is not sufficient for this. It's conceptual, very, very high level conceptual. It's one of those things that if you do not spend sufficient time focusing on it, then you are going to be in for a world of hurt on the exams. I don't like to do horror stories because I don't want to discourage people, but I've had otherwise straight A students come into this class and basically sit for the first exam and tell me that it was the worst they've done on every exam, first exam, because they came out with the same approach, that they knew how to answer the questions, but didn't really think about what the questions really meant. The good news is that I've adapted my teaching since that's happened, and I think that we'll all have a fairly good conceptual understanding by the end of this week, but it's important you take it seriously. If you put a half-hearted effort into this chapter, the rest of your semester is going to go really rough. That's all I can tell you. So with that, let's get into the first part, which we're going to be talking about evidence, and we're going to talk about assertions and evidence. Now, I've already talked about management assertions to some degree with you, but this is the part where we get into depth about what we mean by management assertions. So just as a reminder from Chapter 1, when I talked about this, these are also called audit assertions. In fact, anytime you hear the word assertion used in this course, you should probably default to the assumption that I'm talking about one of these 8 items. All right. I'm going to go through these items really quickly because we're going to go through them all in detail individually. So we've got our big 3, which are going to be completeness, existence, occurrence, valuation, allocation, accuracy. I do call valuation, allocation, accuracy VAA quite frequently just for initials, but that's what it means. Then we've got rights and obligations, presentation, disclosure, classification, cutoff, and authorization. If you don't remember our discussion from Chapter 1, this presentation disclosure is officially recognized by the Public Company Accounting Oversight Board as an assertion. It is not recognized by the Auditing Standards Board. Classification and cutoff are recognized by the Auditing Standards Board. So there's a little bit of differentiation in which ones are recognized. So all 4 of these are recognized by both bodies. This one's recognized by the PCAOB. These 2 are recognized by the ASB. Just for our purposes, we're going to learn all of them. Okay, all of them, what are them. I've put an authorization here. If you remember, authorization is not a real assertion, and I will hold to that. It has not been a real assertion since probably 2005, but the author of this textbook, you flat out refuse to remove it from their textbook, and I'm going to overlook it because it's a good textbook otherwise, but it is not a real assertion. It is relevant to auditing. We're going to talk about what authorization really means in context to controls, and you have some idea about that already. But For as far as being a management assertion, it really is a subset of existence occurrence. So let's go ahead and get into depth about what these 8 items mean. All right, so completeness. So real quick, I do want to make sure, so you're going to see some things on the slides here, all right? So I'm going to have 2 definitions for most of these slides. And the reason I have 2 definitions is because remember, we talked about assertions having relevance at the both transactions and events level and the account balances level. So the way to think about transactions and events is that it affects daily operations of the organization, all right? Because that's basically what an organization does. They accumulate transactions and have events take place over their life. So that's the first way to think about it. The second way is to think about the aggregation of information in the financial statements. That's account balances, okay? That's basically what the presentation of information is in the financial statements. Most of the assertions apply to both categories, but not all of them. So if you see only one bullet or line item, that means that it probably is related to only one item. And you should be able to get a clue of which one it is related to, because I use the words transaction events and account balances very specifically in my descriptions. All right, completeness. All transactions and events have been recorded. All ending balances for balance sheet accounts that should have been included in the financial statements have been included. Now, the word recorded will be used a lot with respect to these assertions. Completeness is our primary recording assertion. So basically, when you hear me ask the question, what is our recording assertion? You should immediately respond, it's completeness. When we talk about completeness, we are asking the question, did something get recorded? Full stop. Did something get recorded? Full stop. Now, there are other things where we can ask, did it get properly recorded? Like, did it get recorded at the correct amount? That's going to be via valuation, allocation, accuracy. Or did it get recorded in the correct period? That's going to be cutoff. This is just saying, did it get recorded? All right. If the answer is yes, it's complete. If the answer is no, then it's not complete. There is a preface to that. In order for something to be recorded, it must first have taken place. Okay. So a transaction that took place got recorded, it is complete. Or if an account balance actually has underlying evidence that it should be in the financial statements, then recording it makes sure it's complete. Okay, that's what we mean by the recording assertion. So if we have this, we're going to assume that we say something took place, it got recorded. Okay, what if something gets recorded, but we need to know that it took place? That is the other assertion that we're going to talk about. These are offsetting assertions. That's existence occurrence. All right. All recorded transactions and events actually occurred and pertain to the entity. All ending balances for the balance sheet accounts that have been included in the financial statements actually exist. So with completeness, we were saying something took place. We want to make sure it got recorded. All right. This is saying something was recorded. We want to make sure it actually took place. So it's a very subtle distinction, but a very important one. We call completeness and existence occurrence directional assertions. And it's going to become more obvious as we get some experience with it. But basically, when we say directional assertions, we're trying to say that your source information or the source of your transactions exists at the bottom. And then the financial statements, everything that occurs is at the top, okay? So we start with our source, our foundation documents, and we move upwards to the generation of financial statements. Why do I call these directional assertions? Because when we think about completeness, completeness is going to be a bottom to top assertion. Means we're going to start at the bottom, we're going to look at the source documents and then see, did these source documents show evidence that this item got recorded? So we're going from bottom to top. Existence occurrence is a top to bottom assertion. We're going to look at what's in the financial statements or what's in the system, and then we're going to go down and try to find underlying support for anything that got recorded in the system. So the direction is really, really important. Trust me when I say that we'll get plenty of exposure to it. In fact, we've got an activity for our Earthware assignment that's going to reinforce this concept when we get to the end of the week. But these are probably our two or three most important assertions. I think I alluded to this already. Our first 3 assertions, about 70 to 80% of our situations are going to deal with these 3 assertions. What's the third of these? The third of these is a little bit more straightforward. This is called valuation, allocation, accuracy. All amounts related to transactions and events have been recorded appropriately. All ending balance for adjustments in the balance sheet accounts have been included in the financial statements and recorded at the appropriate amounts. So a couple things I want to note about this, okay? First and foremost, this is another recording assertion, but instead of saying, did something get recorded, we're saying, did something get recorded at the appropriate amount or for the proper value? Also, something that you will notice in the book and you will notice in other contexts when they ask questions about the assertions, oftentimes they will use one of these three words. They will use, is it properly valued? Is it allocated correctly? Is it accurate? I don't particularly care which word you use. I just use all three whenever I'm describing the assertion. You don't have to delineate when one word is more appropriate than another. Same is true for existence occurrence. You'll see existence or occurrence used interchangeably. You can just use both terms and cover all your bases. I'm not trying to split hairs and saying, oh, you should have said accuracy, and instead you said allocation. Just say VAA, okay, and we'll be good. All right. So those are our three most important critical assertions. Those are the three that you should know cold, three you should know cold. If you can't answer a question, then take a guess at one of those three. I would say that that's probably good advice in general. Maybe not for this course because I'm sneaky, but it's going to be a good advice in general because these are going to be most relevant in most of our situations. The rest of our assertions still important, but less frequently used. Okay, so our fourth assertion is rights and obligations. Okay, so for all balance sheets, accounts with ending balances recorded in the financial statements, the entity holds or controls the rights to assets included in the financial statements, or all liabilities or obligations of the entity. All right. Now you will notice that there's multiple bullet points in here, but there's actually only one category of assertions listed here. It's ending balances. Rights and obligations relates not to transaction events, but just ending balances. And it's very intuitive. If an asset is on the balance sheet, the organization has the right to recognize that as one of their assets. And if it's an obligation, or if it's a liability, or to that extent, it's stockholders' equity, to the same extent. But I think I just said liabilities. Liabilities or stockholders' equity are valid obligations of the entity. The reason liability is obvious is because by definition, a liability is an obligation, but stockholders' equity should probably be included there as well. So that's fairly intuitive when we think about whether or not a company should recognize something on the balance sheet. If it's not an asset that they own, then they can't recognize it as an asset. If it's not an obligation they owe, then they can't recognize it as a liability or stockholders' equity. That's pretty much it. All right, next we have classification. Okay, I think I transposed classification, presentation, disclosure. Classification is actually a pretty prominent assertion. When it does get violated, it's a big problem, okay? All transactions and events have been recorded in the proper accounts, and all ending balances have been recorded in the proper accounts. We're going to talk a lot about when classification gets violated and why. A lot of times it's not necessarily trying to be directly fraudulent, but it's kind of ancillary to fraud. It definitely can be related to management of earnings or manipulation of earnings. Somewhat closely related to classification is going to be presentation, but presentation mostly has to do with information that's in the balance sheet or in the financial statement. So all transactions and events have been clearly presented and disclosed. All ending balances have been clearly presented and disclosed. Technically, they do not mean the same thing, but as I said, this one's recognized by the PCAOB, whereas classification is recognized by the ASB, so they can be used interchangeably depending on the circumstance, okay? That being said, we are not going to use them interchangeably in this course, but they can be theoretically used interchangeably. Next, we have cutoff, okay? Cutoff, all transactions events have been recorded in the correct accounting period. This one is solely relevant to transactions and events, and basically what it says is, did an item get recorded in the proper period? So we talked a little bit about this in chapter 4. Think about fraud that has occurred with sales transactions. Somebody says, I'm going to be short of my earnings goal. I'm not going to get my bonus. I'm just going to record some sales that would have occurred in January. I'm going to record them in December so I meet my earnings goal. That's nice, but it unfortunately violates accounting rules, and it also violates our assertion of cutoff. We have to make sure all transactions get recorded in the period that they should have taken place. Cutoff is one of those ones that doesn't get violated, but when it does get violated, it's generally for fraudulent intent. Okay, it doesn't get violated often, but when it does, it's pretty obvious why. Then we have the assertion that's not really assertion. This is authorization. I included up here because, again, you will see it in the book. You will see some scenarios where it uses authorization. I can't avoid it as much as I want to try. But authorization is basically saying all recorded transactions and events have been properly authorized. I will tell you that I will never ask you a question to identify assertion on an exam where authorization is the correct answer, at least not with respect to assertions. Will I use authorization within my questions? I will definitely use it when we start talking about segregation of duties, but it is not a real assertion. It's not really a financial assertion. The only reason I keep it out in here is because it's in the book, okay? So that's it. That's the list of assertions. You can actually go to table 5.1 in the book, and it actually talks about the assertions within context to each of the categories of assertions. So again, whether it has to relate to transactions and events or account balances. I tend to be more of an object learning person, so we're going to talk about it in context to certain situations. But if you want the general definitions of those, you can actually get those in the book. There's a couple of tables on this. Table 5.2 actually breaks it down as well, talks about them within context of the categories of assertions as well as the PCOB assertions. And you can kind of see here, PCOB doesn't have an authorization, cutoff, or classification listed there because they're not listed as PCOB assertions, just the other 5. Again. Oh, by the way, I won't ask you, I don't, I'm 100% certain, 99.8% certain. I will not ask you which category assertions are relevant to the PCOB and which ones are relevant to the ASB, at least not on this first exam. I don't think I'll ask it on any of the exams, but I can tell you a 99.8% certainty I will not ask that. Okay. I don't want to say 100% because I don't know. I may be forgetting something, but I think it's more important that you know the assertions at a general level than trying to categorize them according to whether they're PCOB or ASB relevant. So when we use assertions, the whole goal of an assertion is to be able to identify what it is we need to do to validate management's assessments. Because remember, the reason they're called management assertions is when the management presents information, whether they relates to transactions, events, or account balances, they are making an assessment, or they're basically making some sort of representation as to the state of that. Again, the simple example we talked about is inventory. Inventory is properly valued and it exists. So we want to make sure that we understand what are the assertions we're concerned about and how we're actually going to test those. Now, as a little bit of a spoiler, a little bit of a key, one of the things that we're going to see very consistently, especially when we get to the business process areas, is when we start talking about assets and revenues, existence occurrence is going to be a very critical assertion for assets and revenues, which makes sense because if you're an auditor, are you more concerned about your client overstating revenues or assets and revenues, or understating assets and revenues? Overstating, because that's how you commit fraud. So we want to make sure that those revenues actually exist. We want to make sure those assets actually exist. The reverse is true for liabilities and expenses and owner's equity. Completeness tends to be the problem because they tend to understate those. If you're trying to maintain your earnings, if you want to understate expenses, if you understate your expenses, then you can increase your income. So we have a responsibility as auditor to make sure that they're fully complete. That is not to say that those are the sole assertions we're going to test, but those are some of the primary assertions we can easily identify. Okay, so here's an example of audit program for accounts receivable. And as you can see, for accounts receivable, we've identified 4 assertions that we think are important here. Okay, existence, occurrence, rights and obligations, completeness, and accuracy of allocation, or allocation accuracy. Allocation, allocation, accuracy. I got confused because they put them in a different order. Darn the book for being creative. All right. What we'll notice here is that once we've identified the assertions that are relevant in a given area, it is up to us as auditors to determine, how do we test those assertions? How do we test those assertions? And the answer is we collect evidence. Specifically, we collect 1 of 10 types of evidence. Okay. Now you're going to ask, are we responsible for knowing all 10 types? The answer is yes. Not only yes, but very, very well. The good news is we're going to have so much exposure, it's going to become very obvious. Okay. Again, this is not a memorization task. Memorization is so far beneath what I'm asking you. Okay. If you memorize the words, then you're not going to be set. Okay. You need to know the assertions. You need to know the evidence. Okay. But that's why I'm going to throw so much at you and why we're going to repeat it over and over again, because I think that this is really, really important. So before we get to the different types of evidence, let's go ahead and let's talk about what it is that promotes evidence, or what it is the considerations we have for evidence. So this is another one of those things. This is going to happen by a lot in this chapter, is we're going to have interchangeable terms. So remember I said management assertions can also be called audit assertions or just assertions. Audit evidence, we can actually use the term audit testing or audit procedures as well. They all mean the same thing. So if you hear me say what audit testing you perform. You should automatically make the transition in your mind. Oh, he's asking me, what type of evidence did I collect? All right. Those are the same terms. So audit evidence is the information used by the auditor in arriving at the conclusions on which the audit opinion is based. There are three concepts that are important to understand in the conduct of the audit. Three concepts of evidence that are important to understand in the important audit. Now, these three are important, but they're not difficult. Okay, the three are very important, but they're not difficult to understand. The first of these is the nature of audit evidence, which is probably the easiest question that I would ever ask you on an exam if I ask you this question, okay? We'll talk about what that means here in just a second. Secondly is sufficiency and appropriateness, which once I define it, you'll say, oh, that's easy too, all right? The final one's probably the most challenging. This is the evaluation of evidence, but it's not particularly difficult once you actually have the explanation. So what do these mean? Let's go through each of these individually. By the way, this is another one of those ones that this is not sufficient to memorize. You do need to know what each of these mean, okay? Is it possible that I can ask you which of these or which of these three are important concepts? Certainly, okay? It's much more likely I'll ask you what they mean, what they represent. All right, so the nature of audit evidence refers to the form of type of information, okay? There's basically two type categories for information when we talk about audit evidence. The first of these are going to be accounting records. All right, and I'm not going to read the big long definition because it's just a definition of accounting records. If you want to read that on your own time, I encourage you to do so, that you know what accounting records are. So the second category of this is going to be other information. So it's basically accounting records and then everything that's not accounting records. It's like that old quote by Mark Twain. There's only two times in life that you shouldn't gamble. It's when you don't have the money and when you do have the money. All right. This is basically the same answer to that question. What type of evidence do we collect? Accounting information and stuff that's not accounting information. All right. Now, this encompasses quite a bit. As we're going to see, there's a lot of detail that we can actually capture within the area of non-accounting information, but it's really important to make that distinction. And the reason why is because if we approach this just from the perspective of gaining accounting information, we're missing a critical part of what the assertions, how we could actually validate certain assertions. So we need to be pretty dynamic as auditors and not just look at the records and documents, but also look at other sources of information. All right, second category. So sufficiency is the measure of the quantity of audit evidence. Did we gather enough audit evidence? That's all there is to it, full stop. I hate blank slides. Like I really don't have anything to say on the slide, so I just put a meme in here just because I thought it was funny, okay? But it has nothing to do with the definition. All you need to know from this slide is sufficiency represents the quantity. So if that's the case, what do you think appropriateness means? Quality, quality of audit evidence. Now, this is a little bit more distinct, okay? When we talk about evidence being considered appropriate, it provides information that's both relevant and reliable, okay? Now, relevance of audit evidence refers to the relationship to the assertion being tested. Now, this is a little bit different from financial accounting information. If you remember SFAC number 8 in financial accounting information, it says relevance and faithful representation, representational faithfulness. Yeah, so very similarly related, but not exactly the same thing, okay? So relevance is basically saying, how does it relate to the assertion being tested? If information is not relevant from an audit perspective, we're saying, look, that could be valid information, but I'm concerned about this assertion and you're not getting me information that's related to that assertion. So I'm saying I'm concerned about the value of inventory and you hand me a document that shows that the inventory was recorded. I said, I don't care if it's recorded. I want to know, is it recorded at the appropriate amount? You gave me information about completeness. I want information about VAA. All right. That's relevant information. Reliability evidence refers to whether a particular type of evidence can be relied upon to signal the true state of an assertion. All right. So I'm concerned about whether inventory in the current period is properly valued. You hand me an inventory count from last year. Like, okay, that's great for last year, but I don't care what the numbers were from last year. I care about the numbers from this year, right now at this point in time. All right. This is not reliable information because it doesn't actually have any context to what we're talking about. Okay, it doesn't have any context. So it doesn't signal the true state of the assertion. This is a really important concept, obviously, because we want to make sure that not only is our evidence, do we have sufficient evidence, but our evidence does what we say it does. If our evidence is not consistent with what we say it does, then basically it doesn't give us any assurance. It doesn't give us any support for the representations we're trying to make. By the way, I've said that already but many times before, but you hear me say that term a lot. At this point, we are gathering assurance. And when we gather assurance, what we're trying to do is we're trying to get enough support to either make a conclusion, to either state that the client is financials are free from material misstatement or say something else that's inconsistent with that conclusion. We're going to talk a little bit about that at the end of the discussion. Yes.
So you said that inventory records from last year are relevant because they are like the records are not reliable with their last year.
Right. So that would be a relevant record for that particular item, but it just wouldn't, that particular record would not signal the true state of an assertion because it's old. Okay. It's outdated. That's the easiest way to think about reliability. But there's a lot of different ways that things can be unreliable. Like, for example, you could be an auditing professor. That's very unreliable. Yeah. Yeah. I'm sorry. If you're not gonna if you're not gonna say something valuable, then just say something self-degrading, and everybody will kind of laugh. All right, all right. So last thing we're going to talk about is we're going to talk about evaluation of audit evidence. Okay. So when we talk about evaluation, what we're trying to determine is we're trying to make sure that our evidence does support everything we're trying to get in the conclusion, which is very similarly related to the idea of support, the sufficiency and appropriateness. But there's a little bit of distinction. So first of all, we need to make sure that the types of evidence that we're trying to gather are available. This is actually going to be very relevant later on. We start trying to make a determination about what testing we're going to conduct in a certain area. Because some testing may be a good signal for a correct assertion, but it's not something that we as auditors can collect. So we need to understand what is available to us. We also need to know the relative reliability or diagnosticity of the evidence. So there's that term reliability. It means there's some relationship, but then we have this idea of diagnosticity, okay? Which, by the way, if you type that into Google search, it won't recognize as a real word, but it does have a real definition. It basically says, how well does our evidence support a given premise versus the available alternatives? We're going to talk a lot about confirmation bias in a few weeks. Like the next Friday, we're going to talk about confirmation bias. And one thing we're going to find with evidence is a lot of people look at evidence and say, this proves what I said it was. They said, no, this actually proves something more. There's something else than what you said. We want to make sure that if we gather evidence and we say that it supports a particular alternative, that it actually states, or it actually supports that alternative versus something else. If there's another explanation that the evidence supports, then we may have to consider that possibility. That being said, in evaluating evidence, an auditor should be thorough in searching for evidence and unbiased in its evaluation. Unbiased, that's going to be that confirmation bias that we just talked about before, which is certainly problematic. Thorough is going to make sure that we're going to talk about something called the availability bias. I say bias, we're actually going to call them tendencies, but it's exactly the same thing, which are certainly fallacies that people have in logic because they don't collect enough information, and the information they collect, sometimes they collect information that only supports their preconceived notions. It's great to do that if you're a human being, if you just want to be an incomplete human and say, okay, I don't care if I have availability bias, I don't care if I have confirmation bias, it's what I believe. Can't do that as an auditor, unfortunately. If you do that as an auditor, that's when Enron occurs, okay? That you want Enron, that's how we get Enron, okay? So yeah, no availability bias, no confirmation bias. All right, so those are the three components of evidence that we have to have. Very important stuff, but now we're going to get into the nitty-gritty of what we mean by evidence, what evidence represents. So before we get to the list, and there's a substantial list, I want to reiterate some things that we talked about. So remember, we talked about the phases of the audit. We talked about those in detail. And then I said that there were 3 distinct phases in audit testing. Does everybody remember me saying that? I'm not going to ask you to repeat what the 3 phases are, okay? But I do want to make sure that everybody remembers that I said. So what distinguishes phases of the audit versus audit testing? The answer is that when you enter audit testing, you are gaining assurance for your representation as the auditor, all right? During planning, we're not gaining any assurance. We're just gaining information about how to plan the audit. This is the point where we're actually gaining assurance. We're getting information in detail that we can use to make representations at the end of the audit. Remember, the first of these phases in audit testing is risk assessment procedures. Second of these phases comes right after risk assessment is our test of controls. And then once we've wrapped up test of controls, that's when we move on to substantive procedures. And there are 2 sub-phases within substantive procedures. There's substantive analytical procedures and substantive test of details. Now, these align really closely with what we talked about in chapter 4, because remember, we do that audit risk assessment, and then we assess inherent risk and control risk. Our control risk is finalized when we complete test of controls, and that allows us to determine detection risk, which sets the stage for how much substantive testing we're going to do. So it is a sequential process for the most part, and it's really important to understand these phases. What you need to know now is that the reason these are called phases in testing, at least the reason I make that distinction, is that each of these phases we can perform certain types of procedures. So This is really, really critical to understand what types of procedures can we perform in which phases and why is that important, okay? But first, before we do that, let's go ahead and talk about what our different types of testing are. All right, so 10 types of testing I talked about. We've got inspection of records and documents. That's pretty obvious. Inspection of records and documents is just looking at accounting records to gain information. Now, generally speaking, inspection of records and documents is probably our most valuable type of evidence collection because it is very versatile and it provides a reasonable level of reliability and can test all of the assertions. That being said, one thing to note about inspection of records and documents is we have two distinct types of testing under inspection records and documents that we need to talk about. We need to talk vouching and tracing. The reason these are important is these are inspection of records and documents testing that test specifically for certain assertions, okay? So there's two of them. Does anybody want to guess which two assertions they test? Copyright some obligations, Dr. Barnes? No, that's not it, no. Yes, completeness and existence occurrence, okay, very good, the first two, okay? Now, why is this important, okay? Why is this important? Does everybody remember I said that these are directional assertions, okay? I said existence occurrence is moving from top to bottom and completeness is moving from bottom to top. This is how we test those directions. Now, I can't take credit for this next item, but there is a very easy way, and this is going to make things so much easier for everybody when they see this. How do we remember bottom to top versus top to bottom? Again, this is Becker, so you can thank them for this particular meme. All right. The V pointing down, that's top to bottom. So vouching tests existence occurrence, okay? And tracing points bottom to top, tracing tests completeness, okay? All ties it together. It's all come big full circle, all right? If you remember this sequence, this will actually be very easy to remember how vouching and tracing work and how they relate to the assertions. Okay. So that's three types of evidence down there. Technically one type of evidence, but specific type form of evidence, okay? Then we have inspection of tangible assets. Inspection of tangible assets, extremely reliable form of evidence because we can go and look at a building and we can determine, oh, wow, that building is right there. They should have included that on their financial statements because I can see that building, okay? Extremely reliable, but it only tests one assertion. Does anybody guess which assertion it tests? That building is right there. Got a button unbuttoned. Existence, that's it. Existence occurrence. That building exists. It's right there. Observation and inquiry, okay? Observation and inquiry are part of our big three. We talked about that last week. Remember, there are three types of evidence we can collect at any phase of the audit: inspection of records and documents, observation and inquiry, okay? Observation and inquiry. Observation is just as it sounds. We observe people performing certain tasks and processes. Inquiry is we go and talk to people about the tasks and processes they perform. Very, very versatile, very low reliability, okay? Very low reliability. Why? Okay. Is it possible that if people know that you're doing or that they're being watched, that they might change their behavior? Yeah, it's Heisenberg's uncertainty principle right there. Yeah, measurement of an item changes the behavior, not item. Yeah. What about if you're doing inquiry, you go talk to management, and managers commit fraud, and it's like, okay, I need to know about fraud in the organization. The manager's going to say, well, I'm committing fraud. That's something you should probably know. Is that what they're going to do? No, they may lie to you. That's why these are low reliability. Generally speaking, observation and inquiry requires something called corroboration. Corroboration is a fancy term for saying that we have to have additional evidence to support what we learn in those tests. Next, we have confirmation, okay? Confirmation is basically a fancy term for a third-party request. Somebody outside the organization provides us information about the state of the organization. Now, I want to make this clear because this always comes up and I have never been successful. I hope this is the class that will first break this barrier, okay? Okay. Confirmation is a test of account balances almost exclusively, okay? Why is this relevant? Because confirmations cannot be used to signal the nature of transactions and events. So confirmations cannot test transactions and events. What are controls most relevant to? Are they most relevant to transactions and events or account balances? Transactions and events, the day-to-day operations of the organization. Why am I telling you this? Write this down, put this in your head. Don't care what you have to do. I want you to remember this. I'm going to be very sad if you miss this question on the exam. Confirmations can never be used as a test of controls. Now, if you walk outside of this classroom and say it to an audit partner may say, well, I could think of one or two scenarios. For all intents and purposes in this class, confirmations will never be used as a test of control. And you can underline never, write it in capital letters, bold it, do what you have to do. The word never stands paramount, at least as long as you're in this course. Now, will this kind of question come up in the exam? Almost certainly. Will people miss this question on the exam? Almost certainly. Okay. Don't fail me. Don't let me down. Okay, good. That's what I feel. Appreciate the confidence. Appreciate the confidence. Well, I warn people, and then all of a sudden this comes up, and then when I say, remember when I said confirmation is never a test of controls, and they, oh, okay, I have to emphasize this more and more every semester, and it still happens. It still happens. Okay, it's gotten better. It's gotten better. All right. Recalculation. Recalculation is just as it sounds. The auditor recalculates the numbers provided the client. We also have something called reperformance. Reperformance is the auditor reperforms the test performed by the client, or they're not the test, or reperforms the activities of the client. Whenever you see the word re and then a word after it, so reperformance, recalculation, you should think really, really high reliability. The auditor is doing the work, so we consider that to be very reliable. Analytical procedures is our last one. We're going to talk a lot about analytical procedures on Wednesday. This is basically looking at trends or developing expectations from existing financial data. All right. So everybody on board with this? Okay, so quick note. I'm going to scroll back. I apologize for the quick scrolling, but I'm going to scroll back. Let's go through this again. Remember I said that certain evidence can only be gathered at certain phases of the audit? We need to actually define what phase of the audit these evidence can be collected. Will I test you on this? 100%, okay? So let's make sure that we know. Risk assessment, we should already know this because we talked about this last week. We talked about this on Wednesday. What types of evidence can we gather at risk assessment? 3 of these you should be able to spout off really, really quickly because I told you 3 types of evidence can be collected in any phase of the audit. So anybody remember which ones they are? Inspection of records and documents, observation and inquiry. Does anybody remember the 4th one? It's preliminary analytical procedures. So analytical procedures. These are required analytical procedures. We'll talk more about that on Wednesday, but analytical procedures. So that's easy. Inspection of records and documents, observation and inquiry, and analytical procedures. There's technically 5, but we're going to stick with 4, and I'll talk about the 5th one here in a second. 4 types of evidence that we can collect during test of controls. Does anybody want to name the first 3? Oh, inspection of records, documents, observation, and inquiry. You're right. Good job. Good job. You all remember the 3 types of evidence we can collect during any phase of the audit. Okay. The 4th type of evidence is called reperformance. Reperformance can be used during multiple phases, but it is almost exclusively used during test of controls, which makes sense because if we're testing the controls, we're trying to make sure the controls are performing in a certain way. So by reperforming transactions that have already gone through the system, we can actually determine if we get the same result. Very, very potent test. So reperformance, test of controls. There is a 5th test that I want to talk about because you will see it come up, okay? It is called walkthroughs. And I want to defer talking too much about that right now. We're going to talk a lot about them in chapter 6. For right now, all I want you to think about with walkthroughs is that it's a combination of all the other 4 tests, okay? You're going to go back to your slide. You're going to say, Dr. Barnes, walkthrough is not on here. And I say, well, technically, walkthrough is not a form of test. It's actually a combination of multiple tests. That's why I don't include it on this document. But I did want to add it on there because it may come up, okay? Walkthrough is a test of control. All right. During substantive procedures, I want to say for substantive procedures as a whole, we can use all forms of audit evidence, okay? That does come with a caveat, though. For the substantive procedures as a whole, we can use all forms of audit evidence. The caveat is there's only one type we can collect right here, and then we can use the others down here. So for substantive analytical procedures, what type of evidence do you think I can gather? Brownie point for anybody who can guess it. Analytical procedures. Good job. Yeah. You saw the trap. You saw the goal there. Yeah. Analytical procedures. Okay. Again, we're going to talk more about this on Wednesday, so don't worry too much about it right now. And then substantive test the details. This is everything else. Okay. Everything else we can gather. All right. So let's move forward. Got our evidence. One thing we need to note is that I've already alluded to the idea that some types of evidence are more reliable than others, okay? And I said inspection of a tangible asset, reperformance, recalculation, those are high reliability evidence. Observation and inquiry, those are low reliability. So how do we make the determination of whether something is high or low? And the answer is that it really depends on how much the auditor is involved. If the auditor is heavily involved in the processing of the evidence, it's high reliability. If the auditor has very little involvement in the processing evidence, then basically it's low reliability. This is okay. Again, I'm going to rely on Becker for a representation. They actually have a really good mnemonic. Becker has, by the way, a ridiculous number of acronyms, okay? Some of them are very, very good. Some of them are worthless. Like when you start preparing for the CPA exam, the acronym for the COSO framework is completely and totally pointless, all right? If you memorize that and spout it back to me, I'll throw something at you, okay? But this one I think is a really good one, okay? So the acronym for thinking about the reliability of audit evidence is auditor-generated evidence, A, okay? Externally generated evidence, E. Internally generated evidence, I. Oral evidence, O. And then I hate to say this because it's so cheesy. It's U, you know it. That's what they actually say in the Becker book. Yeah, you know it. U is not anything, but it's they just had to do A-E-I-O-U, the vowels, okay? So auditor-generated evidence collected by the auditor, gathered by the auditor, high reliability. External evidence, information that's gathered from a source other than the client, some external source. Internally generated evidence, information that's provided by the client. And then O, oral evidence, that's just basically observation and inquiry. So you don't even have to say oral evidence. You can just say observation inquiry is O, okay? Because that's observation begins with O. That's another way to think about it. Either way you approach it, that's a very, very valid acronym for remembering this. It can be challenging. All right, that was a lot to absorb. We talked about 10 different types of evidence. I told you a whole bunch of different phases they have to collect it in, and I told you about reliability, and we haven't even talked about which assertions each type of evidence collects. Man, if there was only a resource that you could rely upon that you could get some of this information. Well, when it comes to the phases of the audit, hopefully you write down good notes because I'm not going to give you a cheat sheet there. You're going to have to tell me which phase of the audit. And by the way, this is relevant to the discussion on Wednesday because I'm going to ask everybody questions about this. Okay. But for everything else, if you go on Brightspace, I didn't even open it. I'm a failure. Okay. If you go on Brightspace, there's an Excel spreadsheet called assertions, audit evidence. And if you notice, it's got our 10 types of evidence, or technically 8 types of evidence. Sorry, 9 types of evidence. Wow, I guess it's 11 evidence. I didn't count. Man, I'm an accountant too. So remember, inspection record office includes vouching and tracing in it as well. But we have all our types of evidence, and then we have the assertions, and we have the levels of reliability. You're just going to be responsible for categorizing them according to what types of phases of the audit they can be used in. Why is this important? Because I've got several questions that I'm going to ask you about this on Wednesday that are all relevant to the discussion. I strongly encourage you to go look at that spreadsheet on Brightspace to answer the questions for a discussion, because I'm going to be asking you to tell me this information back on Wednesday. I'm going to call on you. I'm going to say, okay, you were assigned inspection or records of documents. What phase of the audit can be used? What types of evidence can it collect? How reliable is it? You're going to have to know all the type of information. Easy way to answer the question. Look at this worksheet, and that's going to give you most of the detail. You also will need to look at your notes on which phase of the audit it can be used in. All right. Is everybody clear on that? Only reason I bring this up is because I brought this up in the past. Said, look, I gave you a spreadsheet with all the answers, and then I asked in this discussion, and somebody says, I think it's existence occurrence only, Dr. Barnes. I said, did you look at the spreadsheet? He said, what spreadsheet? Yeah. Okay, that's right. Does everybody know about the existence of the spreadsheet on Brightspace? Okay. So we've got existence occurrence down. We know about the existence of the spreadsheet on Brightspace. Please make sure you utilize that. It's going to be very helpful for you. By the way, when we do this discussion on Wednesday, it's going to be very, very rapid. We're going to be going through 11 types of evidence. I strongly encourage you to take notes, not just on what your answers are, but what everybody else is talking about, because not only will you be responsible for the type of evidence that you answered, but you're responsible for all the other types of evidence when it comes to exam time. Is this a lot of detail? Yes, but I warned you. I warned you all. All right. I got 5 minutes to wrap up here, okay? So where are we moving from here? Well, we all know the test of controls are going to be coming up next after the exam. But keep in mind that substantive procedures are actually going to set the stage for what happens after tested controls. Substantive analytical procedures will be starting. We'll be talking about that on Wednesday, and then we wrap up with substantive test of details. This will be a lot more sensible, a lot more intuitive once we include test of controls and talk about the natural conclusion from it. It will be very obvious once we get to business processes in the last part of this course, okay? But what is the goal of all of this? Remember I said that we're gathering assurance during these phases? So what does that actually mean, okay? So keep in mind, let's use an example, okay? Let's use an example that you would use. So has anybody taken the capstone course or currently taking the capstone course? Okay, so in the capstone course, you have to do a research paper. So if you do like 1 hour of research, is that sufficient for writing the research paper? What about 2 hours? What about 2.5 hours? Or we're talking about a lot of work if it's more than 2.5 hours. Okay, yeah. So there is some level of work that you're going to perform. And you're going to be happy with that level of work because that will give you sufficient information to prepare your capstone paper. What is that amount? It really depends. There's a lot of different circumstances, but there's some threshold you have to cross. That is the concept of assurance. We have to cross some threshold to be able to retain our assumption that everything is correct. Now, the way that the book describes this is they talk about this as the assurance bucket analogy. All right. You're basically trying to look at different areas. You're looking at different assertions within a particular area, and you're trying to gather assurance during each of the phases of the audit. So the phases of the audit, you can kind of see here, risk assessment is our first phase. Then we have test of controls, substantive analytic procedures, and then our remaining substantive tests. Okay. Every single point in phase of the audit that you perform testing, you're going to gather a little bit of assurance. If you have to skip testing in a certain area, then you have to actually get more assurance in that area. We'll talk about why you might skip testing in a given area a little bit later in the course. It does happen. But for the most part, you're gaining assurance every single time. And at some point, you've got to get to the bucket being to the brim. That is your eventual goal. Get enough assurance that it's full. Okay. If you don't put enough assurance into it, like if you don't do enough research for your capstone paper, it's going to be a crappy capstone paper. If you don't get enough assurance for your bucket, it's not going to give you enough information to signal the true state of a particular situation. Now, this is fine. It's a fairly good analogy, but it's not my favorite analogy. All right. I prefer the Chipotle burrito analogy. All right. Has anybody ever eaten Chipotle or a place like a burrito like that? All right. So when you go in and you order your burrito, they've slapped down a very large burrito, which you think, oh my gosh, this is going to be a ton of food. What is the very first thing they slap on that burrito? Like a metric ton of rice. Okay, a metric ton of rice. And then they put all the other stuff up, like a microscope. They take tweezers and they put like a microscopic amount of guacamole and then maybe like not even a salsa, like a sol. Okay, yeah. They put a little bit of amounts. Why do they put so much rice on there? Because rice is cheap, and if they put more rice on the burrito, then they have to put less good stuff. Have you ever gone to Chipotle and said, "I don't want rice on my burrito"? They give you the biggest glare. They just like, you're a terrible human being. You're going to make us cost money because if they don't put rice in there, they have to fill the burrito with actual good stuff. Okay. Now, from the consumer perspective, the rice is a ripoff. Okay. But from Chipotle's perspective, the rice is a great idea. If they can fill the burrito with something that's very, very cheap and convenient, that means they have to pay less for the other things. That's how we should think about this from an auditor. If we can get a lot of assurance up front, okay, if we get a lot of assurance from our risk assessment, and a lot of assurance from test of controls, that's less work at the end. We're trying to fill that burrito. We've got to get the burrito to a certain level, and we don't care what goes in the burrito. The less work we have to do to go into that burrito, the better it's off for us. So if we can put as much rice in there possible, if we say, oh, you just want rice in your burrito? Here you go. All right. That's not feasible. It's not technically possible in audit. We do have to go through all the phases of the audits. But if we get a lot of assurance from the controls, that means less work in other areas. It means less of the good stuff. Now, if we don't get any assurance from controls, if we say controls, we're not testing them, that means we have to do a lot more other things. We have to put a lot of the other stuff on there. We have to put chicken, we have to put guac, we have to put sour cream. I'm not even talking about cheeseburgers, and I'm making myself hungry, okay? Yeah, that's kind of the idea that we're getting at there. So that's how to keep that in mind, is that eventually what we're trying to do is we're trying to get a full bucket or a full burrito, whichever you prefer, is our end result for the audit, is the idea of this gathering assurance. All right. We got a lot to get ready for on Wednesday. I've given you a lot of information. Please make sure you review it before next Wednesday. Be prepared for the discussion. 100% chance I will call you out. Okay. So the one time in the semester, I'm going to say that we're going to be doing Socratic method. So be prepared. See you then.